Welcome back to Metal Market News. I'm Professor Harry, and today we're stepping into a very sensitive but critical discussion for silver investors because what we are seeing right now in the short-term macro landscape may not align with the long-term bullish narrative that many in this space are comfortable with. As an independent analyst, my responsibility is not to confirm bias but to challenge it where necessary, and the current setup suggests that silver may be heading into short-term weakness driven by a combination of macroeconomic signals, geopolitical developments, and monetary policy expectations. Now, this does not invalidate the long-term thesis for silver, but it does force us to differentiate between short-term price action and long-term value, which are often misunderstood as being the same thing. In this breakdown, I will walk you through the reasoning behind the expectation of a potential near-term decline in silver prices, compare it with broader market behavior, and give you my own perspective on whether this should be seen as a risk or an opportunity. What immediately stands out in the current narrative is the expectation of a short-term downside move in silver, potentially triggered by a combination of strong economic data and geopolitical developments. The projection of a 2% decline may not sound dramatic in isolation, but within the context of leveraged markets and sentiment-driven trading, even a modest move can have amplified effects. From an analytical standpoint, I find this expectation reasonable, particularly when we consider how sensitive precious metals are to interest rate expectations and currency strength. Stronger than expected non-farm payroll data, combined with a lower unemployment rate, signals resilience in the labor market, which in turn reduces the urgency for central banks to implement rate cuts. This is a critical factor because precious metals, including silver, tend to perform better in environments where monetary policy is easing rather than tightening or remaining restrictive. When I compare this situation with previous market cycles, it becomes evident that strong economic data often acts as a headwind for metals in the short term, even if the longer-term fundamentals remain intact. At the same time, the geopolitical angle adds another layer of complexity to the situation. Developments involving Iran, particularly the escalation suggested by recent military incidents, introduce uncertainty into the market, but not always in the way investors expect. While geopolitical tension is typically seen as bullish for safe haven assets like gold, silver does not always respond in the same manner due to its industrial component. In fact, heightened geopolitical risk can sometimes lead to concerns about economic slowdown, which negatively impacts industrial demand for silver. This dual nature of silver, being both a monetary and industrial metal, creates a unique dynamic where it does not always benefit from the same drivers as gold. In my view, this is one of the most misunderstood aspects of silver investing, and it explains why silver can underperform even in environments that appear supportive at first glance. Now, when we bring monetary policy expectations into the discussion, the picture becomes even clearer. The data suggesting a high probability of unchanged interest rates, with even a small possibility of rate hikes, reinforces the idea that the Federal Reserve is not in a position to pivot toward easing in the near term. From a market perspective, this strengthens the US dollar and increases the opportunity cost of holding non-yielding assets like silver. When I compare this with historical patterns, it becomes evident that periods of stable or rising interest rates tend to suppress precious metals prices, at least temporarily. However, I would also caution that these expectations are not static. Market sentiment can shift rapidly, and what appears to be a stable outlook today can change with a single data release or geopolitical event. Another point worth analyzing is the skepticism around economic data revisions and the reliability of initial reports. The observation that employment figures are often revised after their initial release raises valid questions about the accuracy of the data that markets react to in real time. From my perspective, this is less about manipulation and more about the inherent complexity of measuring large-scale economic activity. However, the impact on markets is real, because traders and institutions make decisions based on the initial data, not the revised figures that come later. This creates a situation where short-term price movements may be driven by incomplete information, leading to volatility that does not necessarily reflect underlying fundamentals. When I compare this with long-term investment strategies, it reinforces the importance of focusing on structural trends rather than reacting to every data point. In terms of market mechanics, the expectation of a price move at the next market open highlights the role of sentiment and positioning in driving short-term price action. When markets are closed, information continues to accumulate, and when they reopen, prices adjust rapidly to reflect new realities. This can lead to sharp moves that appear sudden but are actually the result of delayed reactions. From an analytical standpoint, I see this as a normal function of market behavior rather than an anomaly. However, it does create opportunities for investors who are prepared to act when volatility increases. The idea that a short-term decline could present a buying opportunity is one that I generally agree with, but with the caveat that timing such moves requires discipline and a clear understanding of one's investment horizon. When we shift the focus to the long-term fundamentals of silver, it is important to recognize that these have not fundamentally changed. Industrial demand remains strong, particularly in sectors such as renewable energy and electronics, and supply constraints continue to be a concern. However, these factors operate on a different timescale than the short-term drivers discussed earlier. This is where many investors make a critical mistake by conflating short-term price movements with long-term value. In my view, a temporary decline in price does not invalidate the long-term case for silver, but it does require investors to manage their expectations and avoid emotional decision-making. Finally, when we consider the broader investment philosophy being presented, the emphasis on personal responsibility and independent decision-making is particularly important. No analyst, regardless of experience, can predict market movements with absolute certainty, and any projection should be treated as a probability rather than a guarantee. This aligns closely with my own approach, where I focus on analyzing scenarios rather than making definitive predictions. The idea of using short-term weakness as an opportunity to accumulate assets is a strategy that has proven effective over time, but it must be executed with careful consideration of risk and market conditions. In conclusion, what we are seeing in the silver market right now is a classic example of short-term pressure driven by macroeconomic strength and monetary policy expectations, set against a backdrop of strong long-term fundamentals. The potential for a near-term decline is real, but so is the opportunity that such a move could create for disciplined investors. As always, the key is to separate noise from signal and to approach the market with a clear, rational mindset rather than reacting emotionally to short-term developments.